mean,
right.
what we need to get out of this, right? There's two options. Option number one, debt jubilee at some point. Okay. Option number two is rapid nominal GDP growth, right? Which destroys the value of the debt, or erodes the value of the debt. Destroys the wrong word. Erodes the value of the debt over time. And it can happen quickly. Like I said, 5 years in the 60s, given where bond yields were and term risk premium was kind of where it is exactly now. I mean, ours was actually just recently negative, right? So the what you earn from taking the risk in 10 years as opposed to just rolling your money kind of in overnight or short dated. So in those 6 years, from 65 to 70, you eroded the value of a treasury by 30%, right? By a third. So
is that what you mean by Jubilee?
No, that Jubilee would be
because
Jubilee is literally
just forgiving student loans. Let's
all forget.
That's
the beginning.
So and what you're describing is inflation that brings debt down,
or rapid and nominal GDP. So you peg bond yields at 2, and you're growing at 6, right?
So in real terms, you're seeing
correct in real terms. You're growing at 6 or 8, and you can do that quickly. So I'm not convinced that we're going to go back into a deflationary environment. I mean, you can have bouts of, where prices will dip a little bit. But as I said, if you compare this to 2008, 2009, we are starting this, and we're spending much more money than we spent in 2008, 2009, and we're running much more extreme monetary policy than we were in 2008, 2009. We're doing it from higher inflation with headline inflation and even core inflation. We're doing it with higher wage growth, right? And it looks like that chart that I showed you in the 60s, where you kind of do this oscillation, but every single new low is higher than the prior low.
Yep. Yeah. Higher highs, lower lows.
Yeah.
The debt Jubilee alternative doesn't really seem feasible because of what it does to the system, right? For insurance company, for the banks, it doesn't seem like it's anywhere near part of the conversation. So you're left with either growth or inflation to erode away the real value of
it's a combination. That's why I keep saying nominal, right? It's that combination of real growth and inflation. And I don't know what the number is. Let's say it's 6, right? I mean, in an ideal world, you'd have 4% real growth, 2% inflation. But bugger it, if you can't generate the 4% real growth, you'll take 2% real growth and 4% inflation.